Not all stablecoins are created equal. Some of them are rock solid, backed by cash and treasuries, audited, and boring in the best possible way. Others are more experimental, and they work until they don't. So in this video, I'm going to walk you through the most important stablecoins in 2025, which stablecoins I trust most, which ones I'll use but size appropriately, and which ones I use in only very small positions. If you're holding stablecoins idly and you're thinking about earning yield on them, this is the one video you don't want to skip. By the end of this, you'll learn 4 important concepts in stablecoin investing. 1, exactly which stablecoins I consider to be the blue chips, the ones that you can lean on. 2, you'll see which stablecoins are promising but might not yet be fully proven. And 3, the high risk crowd, the ones I'd only ever use in small slices. And number 4, you won't just get my list. I'm going to show you how I grade them, so you can do this for yourself, even if you come across a stablecoin that I don't cover today. So here's my framework. I keep it super simple. First, backing. What's behind the stablecoin? Is it cash and treasuries sitting in the bank account, or is it Ethereum or Bitcoin locked in a vault, or is it something more exotic? Second, track record. Has a stablecoin been stress tested? Did it hold its peg during a banking crisis, an exchange blowup, or a liquidity crunch? Or is it brand new and untested? Third, liquidity. Can I actually move size without slippage? A stablecoin isn't useful if you can't get in and out when you need to. And finally, team and transparency. Who's issuing it? Do they publish reserves? Are they audited? Do they communicate clearly when things get rough, or do they go radio silent? That's the basic lens I use. And with that, let's go to the rankings. Low risk. The blue chips, which represent up to 50% of my portfolio. USDC is the baseline. It's backed by cash and treasuries in their reserve. It's audited, attested, huge liquidity across every single blockchain. Circle went public this year, which only adds to transparency. If someone told me I had to sit in just one stable coin, it would be USDC. Truth be told, I'm comfortable holding USDC as 100% of my portfolio if I had to. I still prefer to diversify, but this is the one I bend the rules for. USDT is the liquidity king. If you're trading size, nothing moves like Tether. Yes, they've had their controversies, and yes, disclosures aren't as clear as Circle's. But the fact is, it survived every stress test. When other stables can wobble, USDT tends to hold up. So I use it, just with my eyes open. PayPal's PYUSD is a stablecoin that's built for payments first. It's super compliant and super boring. Right now, it's not everywhere in DeFi, but that's changing fast. It's worth watching because when PayPal decides to push something, they can move millions of users in a snap. Medium risk. These are solid stablecoins, but still proving themselves, and I hold them up to 30% in my portfolio. Makers DAI, DAI. They are the OG decentralized stablecoin. It's backed by crypto collateral, battle tested through multiple cycles. But here's the catch. A lot of its collateral is in USDC, so it's decentralized in governance, but it still ties back to fiat rails. That doesn't bother me, but it's just worth knowing. USDS. This is Maker's new stablecoin. Maker launched this new issuance to diversify. It's got some of the same DNA as DAI, decentralized governance, and its cautious approach, but it's younger, it's smaller, and it's still working its way into liquidity pools. I like it, but I'm not oversizing it just yet. Go, GHO. This one's backed by Aave, one of the strongest DeFi protocols around. You mint Go against your collateral inside of Aave. The upside is that Aave's governance has a long proven track record. The downside, it's still a little bit early. Peg stability is improving, but adoption isn't massive yet. Frax. Super clever. It uses a hybrid model, part fiat-style collateral, part crypto collateral, with algorithmic mechanisms on top. That flexibility is its strength, but it's also complex. Complexity is fine until stress hits, and then it can become a weak point. However, Frax has weathered every single crypto storm before, so it's mid-risk, but I keep my sizing moderate. They've also just launched Frax USD, which is a fully collateralized with treasuries and cash. It's meant to be simpler and safer, a step closer to USDC in terms of its design. I still keep it in the medium risk category for now because it's newer, but it could graduate if adoption and transparency keep building. Athena's USDE and staked USDE have exploded in growth. They use a delta neutral strategy, spot collateral hedged with perps, so the peg holds and you even earn yield. When funding is favorable, staked USDE throws off huge APY. When funding turns, yields start to shrink. This is one that I size carefully because of its complexity, and it relies on market structure working. Agora's AUSD takes the fiat-backed route, backed by cash and treasuries. It's conservative design, it's smaller in scale, and I like the transparency, but it just hasn't been tested as much in the wild, so it's a solid medium risk play. EUSD. Electronic dollar. It's a mission-driven and it's a more decentralized option. I really like the philosophy, but its liquidity is still thin. That means I only use it in places where I can get in and out cleanly, and it's not one that I size big quite yet. Syrup USDC. This is Maple Finance's yield-bearing stablecoin. It's backed by over-collateralized institutional loans. That's a very different profile than fiat in a bank, but it's not a degen farm either. Supply is well over $1 billion now, and adoption is growing. Risks live in the lending book: counterparty, collateral, credit cycle, but for me, it's a credible medium risk play. High risk. These are experimental and complex, and they make up about 20% of my portfolio and a 2.5% per name. Falcon USD.ai is a synthetic stablecoin, similar in spirit to DAI, but with a different design. Supply has surged over $1 billion, which is impressive, but the peg depends on collateral health and incentives. Until it proves itself through enough stress, I keep it in the high risk bucket. AlUSD is Alchemex's brilliant concept. Basically, you deposit collateral, borrow against it, and the yields they earn from elsewhere slowly repay your own loan. It's called a self-repaying loan. The catch is, if those external yields break down, the system could struggle. The track record's been very solid, but structurally it's more fragile, so I size it small. HYUSD. This one's still early. Yield-backed and trying to build traction. I don't dismiss it, but without audits, deep liquidity, and longer track record, it stays in the speculative camp for me. Avant's AVUSD and staked AVUSD are building aggressively, and liquidity has grown quickly. That's a great sign, but it hasn't been through a full stress cycle yet. I'll use it in small size, but I'm watching how it handles real volatility. Convex USD and Curve USD. These live in the Curve and Convex ecosystems. Strong teams, deep governance culture, and smart mechanics, but with that comes governance risk and protocol risk. For me, that's high risk until they've been through multiple cycles. Resolve Protocols USR. It's what they call a delta neutral stablecoin, backed by Ethereum, Bitcoin, and derivatives. The design pushes risk into a separate protection pool, while USR holders are meant to get a cleaner peg. It's a clever setup, and adoption has grown quickly, but it's new, it's complex, and it still depends on derivative markets functioning. For me, that makes it high risk until it's been through a full cycle at least. USD.ai. This is the world's first compute-backed stablecoin. One USD.ai equals $1 worth of GPU compute on GPU.net. It's a fascinating idea, tying money to compute, but right now it's thinly traded, brand new, and totally untested. For me, that's pure high-risk experimental territory. Just a quick note: if you're serious about stablecoin investing, I put together a free stablecoin quick reference guide. It's the same framework I use for my own portfolio: risk tiers, position sizing, and the way I think about stablecoin safety. Grab it for free. The link's in the description. And once you sign up, you'll also get my weekly updates whenever I adjust my portfolio or change the grade of a coin or a protocol. Now back to the video. Here's how I size positions. For most low-risk coins, I don't let them run to more than 10% of my portfolio. For medium risk, that's 5%. And for high risk, 2.5%. That way, even if something breaks, I'm protected. But there's one exception, and that's USDC. It's the one stablecoin I trust enough to overweight. So when I say low risk should make up about 50% of my portfolio, the truth is that most of that portfolio will be in USDC. USDT will play a role, PYUSD might grow into it, but USDC is the core holding I don't mind letting run bigger. Now let me also make something clear about yields. When I'm lending or investing with USDC and I'm paid back in USDC, that's what I like to call real yield. When a protocol pays me in their own token, that's not the same thing. But I don't ignore those opportunities. I just make sure I claim those rewards often, and then I immediately convert them into a stable asset. I know I'll lose just a little bit on slippage and fees, and I know those incentives dry up fast, so I treat them as short-term and opportunistic. So there you have it, my 2025 stablecoin rankings from safest to riskiest. If you found this helpful, hit subscribe. Every week I share how I'm earning yield on stablecoins while keeping capital safe. And don't forget to grab the free stablecoin quick reference guide in the link below. It'll give you my full framework in writing so you can refer back to it anytime. This video is for educational and entertainment purposes only. Nothing shared as financial advice. I am not a licensed advisor. Always do your own research and consult a professional before investing.